Earnings growth and dividend growth. Importance of earnings growth. Earnings growth is a key financial objective for many profit-seeking organizations because it signals increasing profitability and improved operational performance. Sustained growth in earnings demonstrates the organization's ability to generate higher returns from its investments and maintain competitive advantage. Investors often view earnings growth as an indicator of future value creation, which can lead to higher share prices and stronger investor confidence. Management therefore focuses on strategies such as cost control, revenue expansion, innovation, and operational efficiency to drive long-term earnings growth while maintaining sustainable financial performance. Role of dividend growth in shareholder returns. Dividend growth is another important objective for companies seeking to attract and retain investors. Dividends represent direct cash returns to shareholders and provide evidence of the company's financial stability and profitability. Many investors prefer companies that demonstrate consistent and predictable dividend increases because this signals strong cash flow generation and prudent financial management. Dividend policies therefore balance the need to distribute profits with the need to retain earnings for future investments. A sustainable dividend growth strategy supports investor confidence while maintaining sufficient funds for business expansion. Relationship between earnings and dividend policies. Earnings growth and dividend growth are closely linked but must be managed carefully to support long-term corporate strategy. While rising earnings provide the capacity to increase dividends, management must consider investment opportunities and capital requirements before distributing profits. Retaining earnings for reinvestment may generate higher long-term returns than immediate dividend payments. Conversely, excessive retention without clear investment opportunities may disappoint investors seeking regular income. Effective financial strategy therefore requires balancing earnings reinvestment and dividend distribution to maximize shareholder value while sustaining organizational growth. Consideration of the interests of stakeholders. Organizations operate within a network of stakeholders whose interests must be considered when making financial policy decisions. Key stakeholders include shareholders, employees, customers, suppliers, lenders, governments, and the wider community. Each group has different expectations from the organization. Shareholders seek returns through dividends and capital gains, while lenders focus on the entity's ability to repay debt and interest. Employees expect fair wages and job security, and customers require quality products and reliable service. Financial strategies must therefore balance these interests to maintain strong relationships and ensure long-term organizational sustainability. Ignoring stakeholder expectations can damage reputation, reduce competitiveness, and ultimately affect financial performance. Stakeholder interests often conflict, which creates challenges for management when setting financial objectives. For example, maximizing shareholder wealth might involve reducing costs or limiting wage growth, which may conflict with employees' interests. Similarly, customers may demand lower prices while shareholders expect higher profits. In such situations, managers must prioritize objectives while attempting to achieve an acceptable balance between competing demands. This often involves adopting strategies that deliver satisfactory returns to shareholders while maintaining good employment practices, customer satisfaction, and environmental responsibility. Successful financial management therefore requires negotiation and compromise among stakeholder groups. The concept of agency theory explains potential conflicts between shareholders, principals, and managers, agents. In large organizations, ownership and management are often separated, meaning managers control daily operations while shareholders provide capital. Managers may pursue personal objectives, such as career advancement or increased compensation, that do not fully align with shareholders' interests. Financial policies, governance structures, and performance incentives are therefore designed to align managerial behavior with shareholder goals. However, while shareholder wealth maximization is often the primary objective of for-profit entities, organizations must still consider the broader impact of their decisions on other stakeholders to maintain legitimacy and sustainable long-term performance. Consideration of domestic and international tax regulations. Tax regulations play a significant role in financial strategy because they influence investment decisions, financing choices, and overall profitability. Organizations must comply with domestic tax laws governing corporate income tax, withholding taxes, and value-added or sales taxes. Tax considerations often affect how companies structure their operations, investments, and financing arrangements. For example, interest payments on debt may be tax-deductible in many jurisdictions, creating a tax advantage for debt financing compared with equity. Financial managers therefore consider tax implications when determining the optimal capital structure. Proper tax planning helps minimize the organization's tax burden while ensuring compliance with regulatory requirements and avoiding penalties. Multinational organizations must also navigate international tax regulations, which can significantly affect cross-border investment and financing decisions. Companies operating in multiple jurisdictions may face different tax rates, transfer pricing rules, and regulations governing the repatriation of profits. Financial managers must ensure that transactions between related entities are priced according to the arm's length principle to satisfy tax authorities. Double taxation agreements between countries can reduce or eliminate the risk of income being taxed twice. Strategic tax planning may involve selecting favorable locations for subsidiaries, financing arrangements, or intellectual property ownership, provided such strategies remain compliant with international tax laws and ethical standards. Increasing global scrutiny of tax practices has led to greater emphasis on transparency, compliance, and responsible tax management. Governments and international organizations have introduced stricter regulations to prevent tax avoidance and base erosion. Financial managers must therefore ensure that tax planning strategies are not only legally compliant, but also consistent with the organization's corporate governance and ethical principles. Aggressive tax avoidance can damage an organization's reputation and lead to regulatory investigations or financial penalties. As a result, organizations increasingly integrate tax considerations into broader financial strategy while balancing efficiency with transparency, regulatory compliance, and stakeholder expectations. Consideration of industry regulations such as price and service controls. Many industries operate under regulatory frameworks designed to protect consumers, ensure fair competition, and maintain essential services. Regulators may impose price controls or service standards in sectors such as utilities, telecommunications, healthcare, and transportation. Price controls limit the prices organizations can charge customers, which directly affects revenue potential and profitability. Service regulations may require companies to maintain specific quality standards, infrastructure investment levels, or service availability. Financial managers must incorporate these regulatory requirements into financial planning and forecasting, as compliance costs and restricted pricing flexibility can significantly influence investment decisions and long-term financial performance. Regulatory controls also influence the risk profile and strategic decision-making of organizations within regulated industries. For example, regulators may determine acceptable rates of return on capital to prevent excessive pricing while ensuring that companies can continue operating efficiently. This can affect investment incentives because returns may be capped regardless of operational performance. In addition, regulatory approval may be required before companies can implement major pricing changes, mergers, or infrastructure projects. Financial managers must therefore maintain strong relationships with regulators and ensure that business strategies align with regulatory expectations while still pursuing efficiency and value creation. Compliance with industry regulations requires robust governance, reporting systems, and operational transparency. Organizations must regularly demonstrate adherence to regulatory standards through reporting, audits, and performance monitoring. Failure to comply with regulatory rules may result in fines, restrictions on operations, or reputational damage. Financial strategy must therefore include provisions for regulatory compliance costs, monitoring processes, and risk management systems. At the same time, organizations may seek to improve efficiency, innovation, and service quality within the constraints imposed by regulation. Successfully balancing regulatory compliance with financial performance is essential for long-term sustainability in regulated sectors.